Checking account. This is the account most people use every single day. Your paycheck lands here, your bills leave from here, and your debit card pulls directly from it. Think of it as a revolving door for money. It keeps funds moving in and out constantly, but it holds on to almost none of the value over time because it earns little to no interest. Savings account. This one is designed to hold money still. You move funds here that you do not plan to spend soon, and the bank quietly adds a small amount of interest over time. Picture a separate jar sitting next to your wallet. Most banks limit how many times a month you can pull from it, which nudges you to leave it untouched. High-yield savings account. Same idea as a regular savings account, but the interest rate is noticeably higher. These are almost always offered by online banks, which have no physical branches to maintain, so they redirect those savings toward better rates for customers. The experience is entirely through an app or website, but the returns are meaningfully better. Money market account. Imagine a hybrid between a checking and a savings account. It earns more interest than a standard savings account, but it also comes with limited check writing ability or a debit card. Banks usually ask for a higher opening balance, and the more money you keep in it, the better the rate tends to get. Certificate of deposit. You hand the bank a fixed amount of money and agree to leave it completely untouched for a set period of time. That could be 3 months or 5 years. In return, the bank locks in a guaranteed interest rate for the whole term. Picture a sealed vault with a timer on it. Breaking it open early costs you a penalty fee. Individual retirement account. This account is built entirely around one goal, which is life after work. The government sweetens the deal with tax benefits to encourage people to use it. Depending on the type, you either save on taxes now when you put money in, or later when you take it out. There are yearly limits on contributions, and withdrawing early almost always triggers a financial penalty. Custodial account. An adult opens and manages this account, but the money legally belongs to a child. Parents use it to begin building wealth for their kids long before those kids are old enough to manage anything themselves. Picture a locked box that a parent holds the key to until the child turns 18 or 21, at which point full ownership transfers over. Joint account. 2 people share complete access to the same account. Either person can deposit, withdraw, or spend without asking the other. Couples use these for shared expenses like rent and groceries, but business partners and family members use them too. It simplifies shared finances, but it also means total transparency between both parties at all times. Business checking account. This works just like a personal checking account, but sits entirely under a business name. Keeping business money separate from personal money matters for taxes, for legal reasons, and for getting a clear picture of whether the business is actually making or losing money. Most banks charge a monthly fee for these, but include tools built around business needs. Student account. Banks offer these specifically to people in school. The fees are lower, the minimum balance requirements are minimal or non-existent, and the terms are generally more forgiving. Banks use these accounts to build long-term relationships with younger customers early. Once the student graduates or hits a certain age, the account usually converts into a standard one automatically. Trust account. This account holds money that one person manages on behalf of someone else, all governed by a legal document called a trust. It is most commonly used in estate planning, so that wealth reaches the right people under the right conditions after someone passes. The person in charge of the account has a legal duty to manage it solely in the interest of whoever it is meant for.